Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, tax strategist, and today we're unlocking the medical expense playbook for small business owners and entrepreneurs. If your tax bill raises your pulse, think of this episode as deductible cardio. We'll cover the 7.5% Schedule A threshold, what actually qualifies, smart timing, the self-employed health insurance deduction, S-Corp and C-Corp mechanics, HSAs, FSAs, HRAs, QSARAs, and ICRAs, marketplace credits, capital medical improvements, long-term care, paying for family members, audit hotspots, and the records that survive scrutiny. I'll share case studies and a concise action plan so you can keep more cash in your business while staying square with the IRS. First, the ground rules. Medical expenses are itemized deductions on Schedule A. Only the amount above 7.5% of your adjusted gross income is deductible, and itemizing must beat the standard deduction to matter. Example, with $100,000 of AGI and $12,000 of eligible costs, the first $7,500 clears the floor and $4,500 is potentially deductible. What counts? Payments for the diagnosis, cure, mitigation, treatment, or prevention of disease for you, your spouse, or dependents. That includes doctor and hospital fees, dental and orthodontia, vision exams and prescription eyeglasses, prescriptions and insulin, lab work, x-rays, fertility treatments, smoking cessation programs, and weight loss programs prescribed to treat a diagnosed disease. Often missed: Medicare, Part B and Part D premiums, Medicare Advantage and Medigap, hearing aids and batteries, CPAP machines and supplies, physical and occupational therapy, mental health counseling, substance use treatment, diagnostic imaging, and durable medical equipment. Medically necessary counts, purely cosmetic does not. Travel for care is deductible when the primary purpose is medical. For 2026, you can claim 20.5 cents per mile, plus parking and tolls. Keep a contemporaneous log with dates, destinations, providers, and purpose. Lodging is allowed up to $50 per person, per night when away from home for care. Meals are generally not deductible. Now the golden rule: no double dipping. Amounts paid with HSA or FSA funds, or reimbursed by insurance or an HRA, cannot also be deducted on Schedule A. Partial reimbursements are okay, only the unreimbursed portion counts. If a later reimbursement covers an expense you previously deducted, the tax benefit rule can make that repayment taxable in the year received. Timing turns average deductions into great ones. Most entrepreneurs are cash basis taxpayers, so you deduct medical expenses in the year you pay them. A charge on your credit card counts when charged, not when you pay the bill. Use this to bunch costs into a single calendar year and clear the 7.5% floor. Examples: schedule elective procedures together, refill annual prescriptions in December, pay January orthodontia, or therapy invoices in late December if the provider allows prepayment. Pair bunching with income management, deferring revenue, or accelerating business deductions can drop AGI, which lowers the floor and increases the medical deduction that survives onto Schedule A. Beyond Schedule A, the self-employed health insurance deduction is an above-the-line write-off for premiums you pay for medical, dental, and qualified long-term care coverage for yourself, your spouse, and dependents. Sole proprietors, partners, and more than 2% S-Corp shareholders can qualify. Medicare Part B and Part D, Medicare Advantage, and Medigap premiums count. 2 guardrails. Your deduction cannot exceed the net profit from the specific business sponsoring the plan, and you cannot claim it for months you were eligible for an employer-subsidized plan, including a spouse's, even if you declined it. S-Corp owners must run premiums through payroll correctly, paid or reimbursed by the S-Corp and reported in Form W-2 Box 1 only, not subject to FICA. So the shareholder can claim the deduction personally. Miss the W-2 step and you can lose an otherwise valid deduction. C-Corp owners who are bona fide employees can have the corporation pay premiums directly. Properly structured under Sections 105 and 106, employer-paid coverage is deductible to the corporation and tax-free to you. HRAs can reimburse out-of-pocket medical costs tax-free when integrated with compliant coverage. Avoid owner-only designs that violate market reform rules. For pass-through owners, remember the traps. More than 2% S-Corp shareholders, partners, and most LLC members taxed as partners generally cannot participate pre-tax in a cafeteria plan or general-purpose medical FSA. If you want both HSA eligibility and an FSA, use a limited-purpose FSA restricted to dental and vision. Always adopt written plan documents and use a reputable administrator for HRAs to ensure substantiation and compliance. Health savings accounts are the entrepreneur's triple threat tool. If you're covered by a qualifying high-deductible health plan, you can contribute to an HSA. Contributions are deductible or pre-tax, growth is tax-deferred, and withdrawals for qualified medical expenses are tax-free. You can reimburse yourself for past qualified expenses anytime, as long as they were incurred after the HSA was established. This is the popular shoebox strategy. Caution: a general-purpose FSA kills HSA eligibility. A limited-purpose FSA for dental and vision keeps it intact. Don't want a traditional group plan? Consider small employer reimbursement arrangements. A QSERA is for employers with fewer than 50 full-time equivalents who offer no group plan. It reimburses individual policy premiums and out-of-pocket medical costs tax-free up to annual limits, prorated by month. An ASTRA works for any employer size, has no dollar cap, and reimburses individual coverage, but it must meet affordability and class design rules. Both require formal plan documents, employee notices, and substantiation. Coordinate with premium tax credits. QC-ATRA amounts generally reduce the credit, and an affordable ICRA can make an employee ineligible for credits. Get the modeling right before launch so you enhance, not disrupt, employees' net costs. If you buy coverage on the marketplace, the premium tax credit can lower premiums in advance, but it must be reconciled on Form 8962. Here's the twist for entrepreneurs. The self-employed health insurance deduction reduces AGI, which changes the credit amount, which then can change the deduction. The math is iterative. Tax software handles the loop, but planning avoids surprises. Mid-year, project income, update your marketplace application, and consider adjusting advance credits. Keep Form 1095-A and all premium statements. If you reimburse premiums through a QC-HARA or ICARA, understand how those payments interact with credits so no one owes a big repayment at filing. Two powerful but overlooked buckets: home medical improvements and long-term care. You can deduct capital improvements that primarily accommodate a medical condition: ramps, widened doorways, accessible bathrooms, handrails, and stair lifts, limited to the portion that does not increase your home's value. Get an appraisal or contractor estimate to document any value change. Operating and maintenance costs tied to the improvement, like electricity to run a lift or servicing equipment, are fully medical. For long-term care, payments for qualified services are medical expenses, and premiums for tax-qualified LTC insurance are deductible up to annual age-based caps. Finally, you can include medical expenses you pay for a spouse, dependents, and certain supported relatives, such as a parent you support more than half, even if they fail the normal gross income test. Let's keep you audit ready. Hotspots include cosmetic procedures, general wellness programs, gym dues, nutritional supplements without a doctor's letter, non-prescription drugs other than insulin, and any expenses for federally illegal substances, even if state law allows them. Gray area items can qualify with a letter of medical necessity that ties the expense to a diagnosed condition. Build your file as you go. Explanations of benefits, provider invoices, pharmacy annual summaries, and proof of payment. Keep mileage logs for medical travel with dates, destinations, and purposes. For forms, retain Forms 1095-A for marketplace coverage, 1099-SA for HSA distributions, and 5498-SA for HSA contributions, plus W-2s showing S-Corp health premiums and any HRA or FSA account statements. Organized digitally by month so year-end tallying and tax prep are fast and defensible. Quick case studies. 1. A sole proprietor forecasts 120,000 AGI, schedules dental implants and a knee procedure for December, prepays January therapy, and hits $16,200 of medical costs. The 7.5% floor is $9,000, so about $7,200 is deductible. She also maxes a family HSA. 2. A 100% S-Corp owner reimburses $11,600 of premiums, but forgets to run them through payroll. A corrected W-2 adds Box 1 wages only, unlocking the above-the-line deduction. 3. A 5-employee firm adopts a QSERA within 2024 limits, reimbursing individual policies and lowering total benefit spend while preserving tax efficiency. Action plan. Project AGI mid-year. Decide whether to bunch. Pick the right mix of HSA, limited purpose FSA, HRA, QSEHARA, or ICARA. Document monthly and sync payroll with premiums. Schedule a year-end planning session with your tax pro early. I'm David Robson, and this is Tax Smarts Unlocked, where we turn tax anxiety into strategy. Subscribe and join me next time for more proactive planning that keeps cash in your business.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.